Good morning, good afternoon, and good evening, everyone, wherever you are joining us from today. And welcome to this session of Business Breathers, a live webinar series hosted by Goodman Group at Brock University. My name is Abdul Rahimi, and it is my pleasure to serve as Director of Goodman Group at the Goodman School of Business. Goodman Group is a community-focused learning and development services provider that works to support professionals, businesses, and entrepreneurs actively pursuing growth through accredited professional development certificate programs, executive education, consulting services, and startup support. We have well over 350 registered for this session, and it is my pleasure to welcome you all from all corners of this globe. We have a truly global audience into today's session who are taking a break, taking a breather, and joining us as part of this session of Business Breathers. This webinar series aims to provide 45 minutes of breathers filled with insightful discussions on timely topics that are relevant to businesses excuse me, and everyday lives, led by Brock University faculty and leading industry experts, encouraging thoughtful debate and keeping us all feeling connected together, which is ever so important in this environment. This webinar series is hosted on Wednesdays from 11 to 11:45. In a moment, I will hand the screen over to Dr. Samir Trabelsi, who will be leading today's discussion on the topic of governance in the era of COVID. But let's just pause for a moment and go through the agenda and the format. Dr. Trabelsi will speak for about 30 minutes around the topic, and then he will spend some time taking your questions and answering your questions. And we have received so many questions at the time of registration, but I would also encourage you to put your questions and comments in the chat feature, which is live now. And also, if you have any questions or comments, also encourage you to post those on your social media using Twitter. And you can tag us at GSB Goodman Group, all one word, that's at GSB Goodman Group. At the end of this webinar, I'll also provide you details on how you may access today's webinar recording. Now, it is my distinct pleasure to introduce today's webinar lead, Dr. Samir Trabelsi, who is a professor of accounting and governance at the Goodman School of Business. He holds a PhD in accounting and a CPA Ontario designation. He has taught courses in corporate governance, external reporting, and research methodology. Dr. Trabelsi has extensive experience of working in industry as well, having practiced public accounting at KPMG in Tunisia prior to his academic career. His research interests are in areas of corporate governance, sustainability, corruption, and risk management. He is an award-winning researcher and a lecturer as well. His research has been funded by the Social Sciences and Humanities Research Council of Canada. He's won the best paper at several conferences, and he's been the recipient of Brock University's Award for Excellence in Teaching and the Department of Research of the Year Award. His accolades are many, but you're here to hear from Dr. Trabelsi on the topic of governance. Samir, welcome. Over to you.
Hello, everyone, and welcome to today's webinar on COVID-19, a crisis in governance or a good crisis for governance. First, allow me to express my sincerest appreciation and thanks to each and every one of the more than 350 participants from over 20 countries for taking the time out of their day or their evening to attend my webinar. I'm Samir Trabelsi, Professor of Accounting and Governance at the Goodman School of Business. I have spent almost a decade to look at corporate governance with a focus on how and when a governance is effective. So today, I'll be looking at uh, governance pre-COVID-19. Then I'll talk about COVID-19 as a black swan, and I'll present the impact of COVID-19 on financial markets, and I'll discuss what kind of scenario. This is very important to assess governance during this pandemic, okay? Uh, and answer the question, or try to answer the question, whether this is a good crisis for governance or it is a crisis, governance is in crisis. Then after that, I'll conclude with kind of suggesting a next normal governance model. Now, let's start with the first uh, 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 point where we're going to discuss what is it governance, and what I mean by governance, because we should be all on the same page, so we're talking the same language. So we need governance because of this delegation of decision making, because of this separation between ownership and control, and because of this separation, we are facing two problems. The number one problem is an information gap. This is the problem that we call adverse selection. So CEO and the company, they have more information than we do because they are insider, but not only because of that, because they have the skills to run the company. The second problem is a moral hazard. We cannot fully observe the CEO, and we use a kind of indirect measure or tools to observe how the CEO or the company is managing through kind of financial reporting. Now, because of this, because of this separation, governance, we need governance to fix four problems. Number one, the effort problem. A CEO maybe have incentive to exercise less effort. Then the horizon problem, because CEO tend to have a kind of shorter horizon for achieving investment results. Then the differential risk preference. As a shareholder, we are kind of risk neutral through diversification, but CEO is kind of risk averse. And then the other major problem is the asset use problem, Now, to fix this, we need a kind of mix of governance mechanisms. And they are seven. The green one are company specific. So we grant stock ownership to the CEO to kind of induce kind of shareholder behavior. We design a compensation package to mitigate the effort and asset use problem. We set up a board of directors to kind of advise and monitor the CEO decision making. Debt and dividend are also another governance mechanism. These are company specific. They vary from company to company. Now, there is also three other external governance mechanisms, which is the managerial labor market, market of merger and acquisition, and blockholder and activist shareholder. I did a Google search for each of these governance mechanisms and with governance. And as you can see, the board of directors, all of them, they attract a lot of attention on the internet. But the one governance mechanism that is attracting a lot of attention is board of directors. Okay. Now, the question now becomes, before COVID-19, were these governance mechanisms effective? And unfortunately, they are not effective across the globe. In fact, for some countries, these governance mechanisms are a second order effect. In fact, we need more than that. We need some institutions. So efficient capital market, or a substitute to an efficient capital market like banks or family business. But these alternative to an efficient capital market, we're not sure they maximize the interest of shareholder other than, or stakeholder other than their own interest. We need also law enforcement and law application. My colleague Professor Paul Dunn, gave a webinar on loophole and how we can use the loophole in regulation for some personal benefit. So we need that investor protection in order for governance mechanism. Also, culture and the social value. We cannot talk about governance effectiveness in countries where the culture does not believe in investing in good governance, or they do the minimum requirement by the regulator. And finally, accounting standard. The quality of accounting standard is a key to effectiveness of governance mechanism, because remember, we do not observe, we do not see 24/24 the CEO decision making. We're going to see them through the lenses of accounting and financial reporting. Now, some countries, including Tunisia, they're going to implement IFRS. Good, but problem is implementation. If we adopt IFRS, but we keep a culture of tax accountant or bookkeeping, and the accounting numbers are noisy, these governance mechanisms are not effective. Now, the World Bank, on a regular basis, they kind of prepare a kind of governance indicator. And as you can see from these slides, take out North America, the rest of the globe, there is a lot of room for improvement for governance. It's voice and accountability, political stability, government effectiveness, regulatory quality, rule of law, control of corruption across. Take out North America, and still there is room for improvement. But other countries, pre-COVID-19, governance is not in a good shape. Now, we are not surprised, right? Because CPI International scores 190 countries and territories by the perceived level of public sector corruption. 100 is very clean and 0 is corrupt. It's very surprising that 2/3 of the country corruption perception index is below 50. The average CPI score across this 180 country is 43. So TPI corruption perception index reveals a staggering number of countries that are showing little to no improvement in tackling corruption. In the last 8 years, only 22 countries significantly improved their CPI, including Greece, Guyana, and Estonia. In the same period, 21 countries significantly decreased their scores. And unfortunately, this includes Canada, Australia, Tunisia, and Nicaragua. Now, in the remaining 137 countries, the level of corruption show little or no change. You know what the Transparency Perception Index report suggests is that reducing big money in politics and promoting inclusive political decision making, these are essential. So, it is overall the governance pre-COVID-19 was not in a good shape. Now, let's turn to COVID-19. I think COVID-19 is like a black swan. So, and black swan are kind of events that are unforeseen and predictable crises that have often extreme consequences. In fact, the black swan events are characterized by 3 main criteria. They're surprising, failing outside the realm of usual expectation, and they do have a devastating effect. And with the benefit of hindsight, they're often rationalized as something that could have been foreseen and had the fact been examined carefully enough. Now, in response to flatten the curve, many governments across the globe have enforced border shutdown, travel restriction, and quarantine in countries across the globe, sparkling fears and impending an economic crisis and recession. Now, uh, what's key for corporation is that COVID-19 implied a disruption in both the supply and the demand side. Uh, mass shutdown of factory evaporated the supply of products. By the same time, the mass quarantining of the population across the globe cut off consumption. Most actually travel, hospitality, restaurant, and retail sector. Now, overall, COVID-19 affected every aspect of the world economy. Now, the primary sectors which are involved are in the extraction and raw material, secondary sector involving the production of finished goods, uh, uh, including all the service provision and industry. Now, talking about the impact, the financial impact of COVID-19, 1,287 of SP rating are now on a downgrade. And warning that and 2/3 of issuer face a downgrade potential. Now, firms in hotel and entertainment industry have the highest percentage of credit watch negative. And many big companies are downgraded to the so-called junk from investment grade. Now, this figure applaud the average equity market return versus asset return for 61 global industry. And as you can see, the global market impact on corporate sector has been bad, especially for oil and gas, hotel, restaurant, air transportation industry. Now, this figure 5 presents equity return by country during the period from January 20 to March 18. And as you can see, equity commodity exporter such as Saudi Arabia, Russia, and Chile has been hit hard because of the oil price. Now, Italy, Spain, and Greece has seen large negative shocks to the equity values relative to the size of negative assets. Now, economists, they are debating. And this is very important from a governance perspective because this is what we need to deal with. We need to deal with scenarios. So the first forecast is that a V-shaped recession, as it's a sharp downturn followed by a quick rebound in growth. If this happens, the economy will rebound very quickly as it has declined. You know, there is a recent EY, Ernst & Young Global Market Confidence Barometer, and in this survey, 38% of companies believe that the recovery will be a V-shape. Now, Jim Kahn, a CEO of Wealth and Hayes Group, argues that those who are arguing for the V-shaped recovery are making two kind of unrealistic assumption. One, we are reopening the economy pretty much all at once. And as you can see from what's going now, it's not the case. And two, consumer won't change their behavior, which also is not the case. We are very careful now. And we avoid like non-necessary going out for shopping and all of that, okay? So a U-shaped recession is more likely. In fact, according to the same survey, the Ernst & Young survey, 54% of companies believe that it will be a U-shaped recession, like the U-shaped recession is more likely. You know, other analysts and economists, they said no, it's going to be a W-shaped recession because the economy will begin to recover rapidly, but because of that second wave, you know, it will fall into a second period of decline. And this will go with a possible secondary outbreak of coronavirus. Now, the worst case economic scenario for COVID-19 is, and I hope it's not going to be the case, is the L-shaped recession. Now, the good news is most economists do not think that this will happen. In fact, the same survey of Ernst & Young shows that only 8% of companies will predict that an L recession and a kind of L-shaped recession is going to happen and is going to last until 2022. Now, regardless of V-shaped, U-shaped, L-shaped, the OECD published a report on June 10th, and they said, in both scenarios, a single hit scenario or a double hit scenario, there is no, the economy won't go back to the fourth quarter for at least 2 years. So the bottom line of this is, regardless of COVID-19 recovery potential scenario, there is no better way to observe the effectiveness of governance rather than during and post-COVID-19. Now, I asked the question, and I posted a poll on LinkedIn and on Facebook. And the question was, COVID-19, is it a good crisis for governance, or it is governance is in crisis? First, I want to thank all those who viewed the poll and did not answer. At least they're aware of the topic. But more importantly, I want to thank the 125. And as you can see, they come from more than 20 countries. And this is what they think. So as you can see, 27%, and these participants are from countries across the globe, they believe that COVID-19 witnessed a crisis in governance. Whereas 23%, they think that, this is good for those governance professionals, and for us to kind of invest in governance, it is a good crisis for governance. Now, 50%, they think it could be both, depending on how we go about this crisis. Now, let me discuss how COVID-19 is a good crisis for governance. COVID-19 has an impact on one of the governance mechanisms, which is executive compensation. And to share the pain, many company, many CEO, they decided to cut back on their compensation package. So, for instance, United Airlines CEO decided to take out 100% of the base salary for 6 months. Whereas Disney executive chairman, he said 100% of my base salary of $3 million. Now, so here it's a good a crisis, and kind of governance mechanism played a good way, Now, this is a framework that one can use to assess board effectiveness. What we observe on the right is the company financial performance during the crisis. And that's an outcome. That's an outcome of how successful the board is going to fulfill its service, strategy, and oversight. And let's not dream about it. If there is a kind of strength, it depends on the strength on the composition, characteristics, structure, and process. I mean, going over this might take you a whole webinar, but I'll share with you what I think and how the board of directors reacted during this crisis. So what we have seen is board, they do focus on the top priority now. It's shared among all boards of directors across the globe. The top priority now is health and safety. Boards they stay informed, and they always, you can see in the business press that board member, they assess and reassess the financial resources, and they do review the crisis response plan. We have seen also board do oversee and assess on a regular basis risk management plan during this COVID-19 pandemic. And they do kind of call upon board to reconsider their communication strategy. In fact, we have seen regular updates from many CEOs. Not only that, we have seen a lot of board members, they step in to express opinion and to advise and help the management to handle the crisis. And most boards, they keep what we call a long-term focus. Not only that, I'm so happy to see that board member, they do engage in what we call a lesson learned. I know it's too early to talk about lesson learned, but at least there is some board practices where we see some report in their corporate governance practice statement where they say this is how we should have done it, they think. Now, this is the good side of, this is how COVID-19, it's a crisis, it's a good crisis for governance. Unfortunately, it was also a crisis in governance. The good example is Tenet Health Corporation. Who is this company? It's a health care service company based in Texas. And in response to COVID-19, Ronald Rittenmeyer donated 3 months of his pay to a Tenet Care Fund. Because this company, they fired 10,000 health workers, about 10% of their work. Now the question is, and we are accountants, and in accounting materiality is very important. How material is this kind of sacrifice? It's 1.6% of the total compensation package. So I have seen in many countries company showing support, and they claim, they said we gave $100,000, but when you scale that $100,000 by their revenue, it's really immaterial. In accounting, we do not even record it. Now, also, there is the International Brotherhood Tea Master Blockholder. They criticized the CEO of Tea Master because the board decided in March 2020, during the pandemic, to increase the package of the CEO. And these International Brotherhood Tea Master, they called upon shareholders to vote no on the compensation package and to call upon more independence in the board. So this is a quote that I got from Ken Hall, Tea Master General Secretary Treasurer. He said, we appreciate that Tenet's board has a lot on its plate at the moment, but it does not justify giving a free pass to a pay structure that reserves the least accountability for the highest paid individual. Okay? And they go on to say, for these reasons, we urge shareholders to join us in voting against the company say on pay for our resolution and for our resolution to appoint an independent chairman on the board. COVID-19 reflects a crisis in governance because there is a high CEO-employee gap. Walmart is an excellent example. You know, the average worker compensation of Walmart is $19,177. The total compensation of the CEO of Walmart is $22,800,000. So it's almost 2,000 times pay for the average employee. I don't think during this pandemic there is a kind of economic explication other than a crisis in governance. Uh, Over the last 40 years, uh, executive compensation, which is a governance mechanism, CEO pay increased 1,000 times, 1,000%. Employee, they did increase only 12%. Uh, in UK, and since 2017, the government requires companies with over 250 employees to report their gender pay gap annually. Now, it will be great if our company across the globe explain this pay inequity between CEO in an economic way. Now, I mentioned previously that board of director kind of did a baby step to adjust for COVID-19, but this is what I see as missing. Does the board recognize its role of accountability and to provide oversight to the company management during COVID-19? This COVID-19 posed a challenge to the duty of care and the duty of loyalty. How we're going to be diligent when it's very tough to forecast what's going to be the word in the next month. I did not see that a change in the structure of the board to kind of address this crisis. And like a new kind of jobs, a new board jobs that was created to deal with this pandemic. Now, how does the board get informed about the crisis? Does the board have an access to internal and external subject matter expert? Do we have medical doctor now on the board to update? Do we have economists on the board? I didn't see that there is a kind of crisis management committee dedicated. I know most companies, they have a risk management committee, and that risk management committee frequently included financially literate experts. I mean, accountants and finance and economists are good and loyal, but now we need more than that. Scoping the problem. What are the key financial risk pressures, and how resilient is the economy to confront this economic outcome? Now, how board is addressing the crisis and its impact on employee, customer, supply chain, and local community? What are the strategic decisions that must be made? And it's very challenging to come out with a kind of time frame. Now, I know shareholder interest is very important. Those are the funding provider. But society also is very important. Now, how will the company balance this interest of shareholder, stakeholder? How we are planning for going concern. I mean, if supply and demand are in serious risk, company might be under going concern. Now, how will the company communicate the economic impact to its business model? All these kind of concerns made me think, and here I'm going to speculate. There is nothing like, it's very tough to kind of predict the next new normal, but this is what I think, and I strongly believe how the next normal governance model. You agree with me that there is no better way to observe the effectiveness of governance rather than during COVID-19. We do really need governance and good governance. Now, I strongly believe that the next normal should shy away from a prospective approach to governance. SOX is very good, regulation is very good, but we know that the compliance will imply that company will do the basic minimum. We need to go over more to a pragmatic principle approach. So promoting pragmatism, discretion serves the interest of both the stakeholder and company. So for me, I think the next normal is a principle-based and consequential governance model. where we all believe that if we invest in good governance and we put in place good governance, then we'll hit 3 targets with one just stone. We fight corruption, we fight fraud, and we're going to create value, not only for the shareholder, but for the nation. Now, this is how my, what I call a SAP governance model. Along of those institutions, we need to build governance. All those 7 governance mechanisms, we need to build them around number 1, social aspect. Human capital, COVID-19 showed that human capital is extremely important. And if human capital is under risk, the whole company is going to disappear. Now, the second element is the environmental attribute. And COVID-19 showed that the environment is key. Now, the third element, of course, is profitability, but I call it sustainable profitability. So the next normal governance model should be built upon these 3 key elements. Now, we always talk about environmental and social and governance attribute. But we have to remember that we need to walk the talk. Because the COVID-19 shifted investor focus on how company treat their employee, their customer and supplier. It's now the S is extremely important. It's not a hype. In fact, in March 2020, more than 280 investors called on company to protect their workforces and their community during the crisis. But unfortunately, many companies have been able to hide behind a positive public declaration about how they value their employees, suppliers, and communities. And I can tell you, they did engage in what I call corona washing. Warren Buffett, a very famous investor, argues that it is when the tide is leaving that you know who was swimming naked. And it is during this time, like COVID-19, you will see which company are living up to their words. Now, let me, before I conclude, comment a little bit about this ESG rating. And I can tell you, there is a wonderful colleague, Professor David Larker, he wrote a nice article on rating the ratings. And the bottom line, these the ratings are in the moon. They are not really with us. They don't deal with something that exists on Earth. In fact, post-COVID-19, I think assessing business risk, decisions, and strategy based on piecemeals, ad hoc, and inconsistent does a disservice to all stakeholders. In fact, a month ago, the SEC chairman, Jay Clayton, said that I have not seen circumstances where combining an analysis of environment, social, and governance together across the border of range companies, you know, one size fits all, would facilitate a meaningful investment analysis that was not significantly over-inclusive or imprecise. In fact, and this is important from a Canadian perspective, recently the European Commission is reviewing the non-financial reporting directive to strengthen corporate sustainability reporting requirements. In fact, accurate, comparable, and material ESG is key for resources allocation post-COVID-19, and so are consistent standard and oversight governing ESG disclosure. Now, to conclude, I strongly believe that it is extremely important for any new normal governance model to work to assess current governance practices. We need to look at us in the mirror. if we do not know where we are going, at what speed, and what matters the most for our society, we will either fall behind or will be simply treading water. By doing so, we miss the chance to turn the risks implied by COVID-19 into opportunities for good governance. Thank you very much.
Samir, thank you very much for that. There's a lot of material that you covered and they're very, very insightful. And judging by the level of conversation and feedback in the chat feature and also the questions that we received, we will endeavor to answer as many of those as we can, but I'm almost certain that we'll probably run out of time to answer all of those. So we will have those answered via email to all of those who have submitted those questions. So my apologies to all of our viewers if we're not able to address your questions as we go through as part of the sessions, but rest assured they will be answered. So here's the first one, Samir. What are the new perspectives to overcome the forthcoming financial crisis?
I think it is very important to believe in governance. Governance should change from a compliance logic to a kind of belief logic. Most company, after SOX, there is many companies that went dark in the United States. And why they went dark? Because, the compliance cost is very high. Now, what concerns me is outside the United States, most countries that adopt the same logic as the United States. What they do when there is a crisis, they go ahead and regulate. I don't think regulation fixes any governance problem. I think incentives fix all the problems. I mean, COVID-19 is a good opportunity for all the government policymakers across and regulator across the globe to create incentive for companies to invest in good governance, not to comply with very basic regulation.
Mm-hmm. That is very refreshing. Not having regulation and using incentives, it makes total sense, at least to me. Here's another one. Are CEOs adequate during the turbulent time of COVID? In other words, do you think they have, or what should be the skill sets and the tools that the CEOs may need in time of crisis like COVID-19?
Excellent question. When I teach my corporate governance class, I tell my student, accounting is the center of the earth because we do not observe the CEO, and to our good luck, we observe the CEO effort among many others, but nobody's going to argue with me. We need that financial statements prepared by CPAs. Now, in COVID-19, these financial, to our bad luck, these financially literate board members are good for the organization, are good to advise and monitor, but for our board member, for our board of directors to work as an effective governance mechanism, we need more than that. We need board members that think in a transdisciplinary. They're good in accounting, but they're good in economics. They're good in reading the health and the medical doctor reports because they're going to have an impact. Now, second element, which is very important, the financial crisis brought to agenda governance, and everybody's talking about, okay, we need to, and it's too sad that policy maker and government, they always respond in the wrong way. Because guess what they did? They put a regulation and companies start doing the basic menu. Now, after the BP oil spill, the environment come to the agenda. And now we care about the environment and company, those environmental disclosure is getting bigger and bigger. With COVID-19, we put the social element on the agenda. But I hope that we're not going to put this social element for greenwashing. We're going to walk the talk. Because, and my forecast, we cannot do it. We cannot engage in a corona washing with this social element, because if we do that, I think we're going to be in financial trouble. And going concern of our organization is not going to, how you're going to do if half of your task force, half of your human capital is hit by COVID-19.
Mm-hmm. Yeah, very insightful. Well, we're almost out of time. And I know there are so many other questions that had come through the live chat, but also those that came through at the point of registration. So we'll answer those after this session via email directly to the individuals. But time to say thank you very much, Samir, for your insightful and inspiring talk and insights in the area of in the area of governance. I want to bring your attention, viewers, to Dr. Trabelsi's next webinar with us, where he's going to be focusing on the area of boards and board of governance. So his session would be boards in the aftermath of coronavirus, and that is going to be held on July 22nd. So you don't have to wait very long, just on the other side of the Canada Day, which will be next Wednesday. And that brings me to say that next week we will not have our usual session on Wednesday because of July 1. And we want to wish Canada a happy birthday and a happy Canada Day. But the Wednesday after that, please join us for our usual session on July 8th, Wednesday at 11 to 11:45, where we will be learning from Dr. Tim Kenyon, who's the Vice President of Research at Brock University, and his topic will be focusing on learning and enabling critical thinking. I do want to take this opportunity to thank Dr. Trabelsi for all his time and effort for putting this webinar together, content here. And of course, I want to thank all of the viewers who came from so many parts of the world. We had a truly global audience this morning with us here, or this afternoon if you are in Europe, or this evening if you are in Asia or other parts of this global audience field. So I want to thank every single one of you for being here, and wishing everyone a happy Canada Day for next week. And I hope many of you can join us again when we're together on July 8th. Until then, stay safe.